Greetings, it is that time of the month again. Our monthly inflation update is upon us. And in this month's inflation update, we are going to go back to my familiar 3-parameter matrix where I say that all 3 of these long-term measurements have to be above 3% before I say inflation is structurally high. And inflation being structurally high is not always because of quantitative easing or money printing either, although it can contribute to that. But all 3 of these measurements have to be above 3%, not one above 3% and one below 3% and things like that. And these 3 measurements are the 10-year compound annual growth rate of the US CPI, the 10-year compound annual growth rate of the Goldman Sachs Commodity Index, and the 10-year US Treasury yield. Now I have to strike a balance between repetition for long-time viewers versus first-time viewers who need to become familiar with this matrix and why I've chosen these 3 parameters. The Goldman Sachs Commodity Index is the most important of the 3 because commodities are A, priced worldwide, and B, are freely traded, so therefore they are exempt from the accusations of being a rigged inflation metric. Also, commodity price deflation versus inflation has a very direct correlation with human well-being or suffering, which is not quite the case with services inflation because service price inflation is simultaneous with wage increases. Service costs for the customer going up are inseparable from a wage increase of the service provider, so it's a lot more ambiguous about whether that is good or bad overall, because the benefit to one person is simultaneous with higher prices to another person. But with commodities, cheaper is better and more expensive is worse. It's very straightforward. Also, inflation would be optimal if all 3 of these parameters were at 3%, because being too much below that is close to deflation and economic sluggishness. Deflation is bad for reasons I've explained many times on this channel. And so 3% would be optimal. It's not some big red alert type of limit. 3.1 would be slightly above the optimal limit and so forth. So we'll go to the 10-year US Treasury yield first. This is the 10-year US Treasury yield, and it's at 4.3%. So this is higher than 3%. The higher this is, the more pressure it exerts on both the US budget deficit, because Treasury yields are higher and the interest paid out of the US federal budget becomes higher, as well as on real estate prices, because mortgage rates are governed by these Treasury yields, and as these interest rates stay high, that is negative for housing prices in the US. It is quite surprising that housing prices have not come down yet, but that is because we are in tremendous stock market momentum right now, therefore there is somewhat of a wealth effect. That does not last forever though. So now we go to the Goldman Sachs Commodity Index. This is the Goldman Sachs Commodity Index, and the 10-year average growth rate is minus 1.12%. It is in deflation. Commodity prices have been in deflation over the last 10 years. Oil prices are lower than 10 years ago. Gold prices are barely any higher. Natural gas prices are much lower than 10 years ago. So this is in deflation, and this being the most important of the 3 measurements indicates why I am so opposed to this inflation fear-mongering narrative. Now we go to the US CPI. This is the bls.gov website as we visit each month, and the CPI is an index like so, and as you can see it rose quickly for about a year, but now it's back to a flatter trajectory. So the 10-year compound annual growth rate of this is taking today's value versus the value from 10 years ago and seeing what the gain was, and then taking the compound annual growth rate of this period over here, and I'll have a table shortly that shows you that. But as we see over here, this 1-month inflation rate recognizes that brief blip we had, but it has subsequently been flat since that time. The 2-month inflation rate indicates the same thing. The 3-month inflation rate, also the same thing. 6-month inflation rate, we've also gotten back down to a low inflation status quo. And the 1-year inflation rate, it hasn't quite got below 3% yet, but it's definitely past this one-time bump. And now we go to a table to represent this data in another way. This table is quite convenient in looking at that bls.gov website in a cleaner representation all in one screen. The 1-year inflation rate is 3.2%, but the 10-year compound annual growth rate is still just 2.8%. So even though short periods have certain volatility, this 10-year compound annual growth rate takes a lot to move up and a lot to move down as well. So it is not a cherry-picked duration, despite what some inflation-seeking people feel. Who are inflation-seeking people? Those who desperately want to feel like victims and ignore all data to say that inflation is high. And I have exposed the emptiness of their arguments many times on this channel. I also indicate what CPI inflation has been since the beginning of the 21st century. So since January 1st, 2001, the average annual inflation rate in the US has been 2.5%. Not any more than that. And that blip that we saw is now receding into this 3-year and 5-year window. Even the 2-year inflation rate is 3.9% because most of that blip is more than 2 years ago, and it resides in these 3-year and 5-year windows. But for the purposes of my 3-parameter matrix, this 2.8% 10-year compound annual growth rate is what we're interested in. So now we go back to that matrix. So we saw all three, the 10-year compound annual growth rate of the US CPI, the 10-year compound annual growth rate of the Goldman Sachs Commodity Index, and the 10-year US Treasury yield. And today, on March 15th, 2024, we see 2.8% for the US CPI, so still below 3%, although not by much, minus 1.12% for the Goldman Sachs Commodity Index. This is in deflation. It's very far from 3%. I contend it can never get to 3% again, and I'm going to modify this measurement to show an even longer term trend line of commodities. And then the 10-year US Treasury yield is 4.3%. This is the only one out of the three that is above 3%, but this being higher is also very bearish for both housing and for US government spending, which both are contributors to CPI inflation. So this staying high too long could pressure these two into going lower as well. So inflation is not high, and I don't care what anybody says because I am taking a very data-driven approach that is not rigged to give a certain conclusion output. All of the critics who say that these methodologies are not the correct way to measure inflation tend to have no empirical rigor in their measurement. They debate via anecdote, or they just assert that the indices are rigged because it's easier for them to feel like victims if they believe that the indices are rigged, but they're unable to prove that they are. Now we go to another measurement that has a lot to do with inflation that people cite as something that will cause inflation to be high, and that is velocity of money. This is a chart from the Federal Reserve regarding velocity of M2. In other words, how quickly money is circulating relative to the money supply. During COVID-19, the money supply increased tremendously, as we know from all the quantitative easing. So the velocity of money fell because money supply was the denominator of that equation. And a lot of people who said that we are about to have hyperinflation when this velocity of money gets back to what it was pre-COVID, they could have been right if it shot back really fast, and that would have been a brief flurry of inflation that died off pretty quickly. But as it took time to get to higher velocity of money, almost back up to what it was pre-COVID, even this factor has now been eliminated as something that could cause high inflation. Velocity of money has been rising since the beginning of 2022, so for 2 years it has been going higher again, and it's back up to this point over here as well, and therefore, like I said, this factor can no longer be applicable as one of the things that even could cause high inflation again. So all the people desperate to see higher inflation have lost yet another big thing they were hoping for: velocity of money springing back to what it was pre-COVID. Now finally, we'll go to some sector level data. This is from CNBC, and while I say that the index should always be what people look at for inflation, everyone who wants to disagree with that tends to throw forth anecdotes that are not even categories of goods, but a single branded good like Doritos or Big Macs or something like that. Always processed food and always something likely to cause inflammation. And I have to wonder if there's some connection there. Their misplaced fears of inflation should in fact be fears of inflammation, given how bad their diets are. But nonetheless, as we see here, look at the things that have fallen in price. Essentials like eggs. The extent to which people think eggs have skyrocketed in price relative to the reality of eggs being in deflation is really quite funny, and I have videos about that on this channel, such as in this tag in the upper right hand corner over here. Many people have just lost their minds on the subject of inflation. Other things that keep falling in price are like apples, lettuce, ham, fish and seafood. All of it's falling. Energy, the whole sector is in deflation, minus 1.9% in terms of what a consumer would spend on energy. Gas service is minus 8.8%. Gasoline is minus 4.2%. Fuel oil, minus 5.4%. And other items that are also very important for consumers have been falling in price. Health insurance, minus 20%. That is huge. Health insurance is a big concern for a lot of people, but at least it has been going down in price. So if you want to get into sector level granularity and debate via anecdote, then I have all these anecdotes to throw back at you. If you are hell-bent on imagining that inflation is high so that you can feel like a whiny victim, unfortunately, a lot of conservatism and libertarianism in the US has become very whiny and victim-oriented, in stark contrast to what it was 40 years ago when it was ambitious, optimistic, and was high on personal responsibility, as opposed to seeing oneself as a victim, even to the extent of making something up, such as inflation being much higher than it is. I don't want viewers of this channel to fall into that type of victim mentality mindset because the data says otherwise. Now, if you like this type of content, I encourage you to subscribe to this channel, and thank you very much for watching.